Hello, everyone. Welcome to the final bar on this Friday afternoon. More distribution today with the market finishing near the lows. That's 2 distribution days out of 5 this week. Following through from the distribution day we had 2 weeks ago. Yesterday certainly feels more heavier than lighter to me looking at the charts. We're going to review all of those as we wrap the week today. Focus on how things have evolved week to week. This rotation away from stocks into bonds. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to make sense of these markets the best we can, connect the short-term movements of what we're seeing today with the long-term trends of and how they've evolved. You know, I've been accused of being overly happy a lot of the time, especially when the market goes lower. So don't get me wrong. I do not find joy in the market selling off like we had 2 out of 5 days this week. But what I would tell you is it makes what we do, I would say, very relevant, because I think the charts are what help you understand this sort of risk-off environment. And when you see panic, when you see euphoria dry up, when you see desperation, when you see fear motivating sellers or an evaporation of buyers, I think that's where the charts become critical to managing your downside risk. And so that certainly brings me joy on our ability to understand the risks that are relevant to us in a week like this. Now, it's not just me helping you navigate these markets. We've got a lot of fantastic guests this week. I was really excited about some of the people we had coming through the show to share some of their expertise. Next week on June 29th, that's Monday, Behind the Charts, which is our interview style show. We sat down with Louis Navalier of Navalier Associates. Louis is a money manager. He calls himself a fundamental quant. So it's a very interesting discussion, with my background in technical research, but spending a lot of time with institutional money managers that are wired a lot more how Louis is. It's actually really fun to have a discussion with him and think about how the charts relate to how he's trying to outperform, trying to win the game. On Tuesday, Jim Smith from GAN Analysis is joining us. On Wednesday, Scott Smith, who's the technical analyst at briefing.com. Next Friday, just as a reminder, it's a shortened week. It's a holiday week next week with Friday off for the 4th of July holiday here in the United States. So we'll take the show off on Friday and we'll wrap the week on Thursday instead. So if you look forward to that on every Friday, it'll be next Thursday. And then the week of July 13th, just as a reminder, Charting the Second Half is coming up. That's a week-long focus on StockCharts TV with special guests, special presentations, a market outlook panel at the end of the week. The team has been working up some fantastic promotional information, and I think you're really going to be excited about what's in store for all of us. So that's the week of July 13th. Let us continue on with our wrap the week. This is our weekly effort to try to make sense of how things have evolved. I know at times when we've wrapped the week, it's been a little easier of sorts because it's sort of an update from the previous week. But now I think we're at one of those inflection points where things are fluctuating. And if you've picked up on my tone going from less optimistic to more pessimistic, and that's maybe not the right way to do it, less constructive about long-term upside and more cautionary about limited upside, that's certainly, I think, what the charts are reflecting this week. I wanted to start off, though, we asked a poll because, again, in any environment, there are always outperformers and underperformers. And I think if you think like that, which is how a money manager would think about this environment, where could you be defensively in the case of downside? It's an important process to go about. We asked all of you, what struggling sector do you think will perform the best over the next 3 months? And we gave you 4 choices: financials, energy, industrials, and utilities. And 3 of those, financials, energy, industrials, these are ones that came on strong a couple weeks ago, right? Those are the beaten down kind of value-y sectors that all just ripped to the upside, with banks looking good, defense sectors, airlines, energy names across the board, just erupting to the upside. And then they've sort of come back to earth in the last couple of weeks, sort of settling back down as the growth trade again reemerged, big cap tech, consumer, and elsewhere sort of emerged again as the leadership. The answers were: number one, industrials with 37% of you. Second, sort of a tie between energy and utilities, both around 22, 23%. And then a financials, fourth place in 19%. A couple things strike me here. Number one, no clear winner, although industrials certainly had the most votes. There wasn't a standout, a standout winner across the board here. Industrials sort of won the popularity contest, but no majority from the results here. Interesting, as banks have sort of sold off, and today financials really leading the way lower, right behind communication services. Energy also down big today. Industrials was actually down just a little bit, almost 2%. Utilities was actually the best performing sector today. So interesting to see. Very few of you actually picked utilities. And today, on a big down day in equities, utilities actually the top performing sector. I asked about a 3-month window, though, and I think that's what the question really gets to. So my purpose of asking that question, what I would hope you do as we go through our process of wrapping the week, we think about some of the sector rotations, and also on Monday when we dig particularly into sectors, is think about some of these sectors that may have been off your radar, and make sure that you don't lose sight of all 11 sectors. There are opportunities out there, and don't get caught off guard with a sector emerging and getting it done on a relative basis, and you're not aware of it. Let's continue this wrap the week. Just as a quick update on what happened today, the S&P finished down, and that really finished down toward the lows, going back below 3010 and closing just above 3009. That's down 2.4% from Thursday's close, where we rallied and really strengthened into the close. Mid caps down a little less, small caps down a little more. So this was not a clear small, then mid, then large, which is some of the pattern we've had recently. This is small caps leading the way lower, but mid caps actually a little less. The VIX back up to just above 34 today. Talking about the other markets, and then we'll continue our wrap session here. The TLT, the bond, long bond ETF, up 1% to 165. We talked in the last couple of days. Yesterday we had a fixed income focus in the show where we talked about the TLT rotating higher, talked about the importance of hitting above the 50-day moving average, hitting above the recent swing high. This is after it broke above trendline resistance. That follow through certainly happened today. So I think bond prices certainly pointing to further upside going into next week. On the commodity side, gold finished higher. It actually opened up a lot lower today, but then by the close had sort of round tripped and gone back to the positive side with the GLD around 166.50. That's up 0.4%. From yesterday, and oil down 2%. Energy, again, one of the worst sectors today, and that's sort of part of that. Let's continue sort of this. Sorry, I'm jumping around just a little bit. We'll focus here on the daily chart of the S&P. We'll do our weekly review from there. So some of the things we talked about looking at the S&P 500 is sort of this pattern of higher highs, higher lows, or lower lows and lower highs. And I say that those phrases so often. My wife makes fun of me often for doing it, but I've often found that it's those simple comparisons that we don't do that a lot of times will keep us out of trouble. So for me, what's the pattern that I'm seeing? I think we've now established a lower high around 3150 that seemed apparent earlier in the week. And I think, Tuesday's session as we traded higher and once again closed down, it really solidified 3150 as sort of the short-term ceiling, the tactical resistance in the market here. We've now today closed below the 200-day moving average, on par to close below the swing low from the second week in June. I think that break below there would confirm a lower low, which would be a lower high, a lower low. We're now in a downtrend. We're not there yet, which means we're right at that point where you'd expect support. And so I think going into next week, a holiday week, which usually tends to finish stronger rather than weaker. If you look at the average holiday week, tends to be a little lighter volume, especially going into Thursday's session. But we'll see if we get the bounce or not. We've now closed through the 200 days. So first things first, do we get a follow through today on Monday? Do we get further downside, or do we get a bounce back, sort of, seeing that the market has established support? So the lowest close that we've seen was right around here, right at the 3,000 level, and that's the level I'd be looking for. It's almost the lowest point today. That's what I'd be looking for on Monday. Interesting to note that the daily RSI has now gone below 50, and we talked about that this week as being, an indication of a change of feel, right? The market, or the S&P, had been above the 50 line for the last 3 months or so. Breaking back below would certainly signal a change of configuration of sorts, and I think we got that today for sure. So at the very least, we are in consolidation mode, which I think we've been for a while. Now I think you need to be eyeing short-term support, identify some levels, not just on the market, but for the market, and not just for the market, but for individual names to identify what we're seeing. Just as a quick check on how things have changed week to week, here we are. This is looking at the last 5 days, and I sort of update this going into the close. So the numbers might be a little off from where we finally closed, but the S&P certainly down and was the worst of the major ETFs that we would follow. The TLT finishing higher, but gold was really the biggest winner, going up 2% over the last week. Commodities essentially flat for the week, and the oil in the form of the USO flat as well, essentially. So this was definitely a rotation away from stocks into bonds and into gold, which was the number one performer out of the three. Let's look at cap tiers. So what we'll do is we're using the perf chart here. You right click, say past week. We're going to look at just the bars, which make it pretty easy to pick out. I'm going to normalize all this to the S&P 500, which is down about 1%. You can see mid caps underperformed by another further percent. So they were down over 2% this week. Small caps were sort of in line with the large cap index, but you can see micro caps had outperformed. But look at all the non-US markets. EFA up 1% relative, emerging markets up 2% relative, frontier markets up 2% relative. So we've talked about the weakness in the dollar, this rotation away from the US into non-US markets. And this week certainly continued that pattern of rotating from the US to non-US. And as a reminder, not that you need to go all in on non-US stocks, but if you're completely naked those, if you don't have any exposure there, maybe worth just seeing if there's some opportunities. Finally, we'll normalize the 11 S&P sectors to the S&P. That is now flat for the week. We're looking at relative movements. So the big losers, the underperformers this week were utilities, which were down 4% relative to the S&P. Energy almost down 4% as well. The next tier after that were industrials and real estate, both down over 2% for the week. The only two sectors that were up on the week relative to the S&P, technology up almost 2%, healthcare up 1/3%. The rest are sort of flat to down, just a rounding error or so. So, we've talked about the relative performance of technology, and in a down tape where I would expect people rotating to the relative safety of big cap tech. This week certainly felt the effects of that with the relative strength of the XLK continuing higher. Healthcare actually notable for being number 2 out of the 11 sectors so far this week. I wanted to divert just very quickly, and I feel like I'm jumping around a lot, but I'll hopefully keep you along this ride with me. We talked over the last week or two, I think it was 2 weeks ago, I came up with these 3 stocks. It was Applied Materials, Morgan Stanley, Starbucks. And I said, if you watch those 3 stocks, I think you'll get a good read on the overall market. My weekly review on last Sunday going into Monday's show, I added 3 more stocks to that list of names that I thought were actually pretty meaningful to watch: Cisco, Nike, and Disney. And I'm grouping these 6 together, calling them the Mindful 6. I created this chart just to very quickly show you where they're at, and I would ask you to focus on where they're all at relative to their moving average and relative to the recent swing low, which is indicated by this horizontal pink line. So here's the S&P testing its 200-day. The swing low is just a little further below us, around 29.50. Stock number 1 is Applied Materials, maybe the strongest of the 6, holding around 59. It would have to get below 55 to get below the swing low and also the 200-day. So that's a key level to watch for Applied Materials. Looking at Morgan Stanley, so it's the only financial stock in here. We now have established a lower low similar to the market. 45 is really the line in sand, the 200-day as well as the swing low. Starbucks is the first stock to be testing this new low. I actually tested it today, already below the 200-day, but testing support. So you'd want to see if we get a follow through, but this is the first one on our list that's actually tested that swing low. So 1 out of 3 now testing support. Cisco holding up okay, and you want to look below 44 for support. I would say Nike is the second one, sort of getting very near to its support around 92.50, and Disney is now our second stock, which is broken lower. So 2 out of the 6, testing that key support level. I would say Disney, the first that's actually confirmed a breakdown with today's sell-off going through. So 5 out of the 6 still remaining above support, 1 out of the 6 still testing it. And that's the list I'll keep looking at in the coming weeks. Again, if these stocks are all able to relatively, for the most part, hold those support levels, I think the market's gonna resist, further dramatic downside. But as these one-on-one break down, I think I'll get more and more, less and less constructive about the prospects for what's coming up next. We're going to finish off looking at the Mindful Investor Live chart list. As a reminder, this is just a series of charts that I look at every week to understand the macro picture. We'll look at this again on Monday as part of our macro overview. The long-term trend following model that I have is actually positive. Turned positive a couple weeks ago. The tactical read, which is looking at the week-to-week change in the weekly PPO, actually turned negative this week. So now we're tactical negative, medium-term, long-term still bullish according to that measurement, which feels about right based on what I've seen. We've already talked about the daily S&P chart. So let's go to the look on breadth. Now, this chart is not updated for the close yet because our breadth indicators lock in after the close, after we digest all those changes. But I would not be surprised if many of these, if not all of them, break to a new swing low. I'm looking at that swing low in the cumulative advanced decline lines, all four of them very near, with mid caps maybe testing them the most. I wouldn't be surprised if these all actually go below their swing low from a couple weeks ago, which means I will color code them red and suggest that the breadth has turned negative. I think it's pretty close to signaling that. Just one or two more charts to look at here, and then we need to take a break. The next one is looking at the percent of stocks above their 200-day, the percent of stocks above their 50-day. Still 64% of the S&P names above their 50-day moving average. The problem is that's down from over 95% just a week or two ago, which means 30% of S&P names have now rotated back below their 50-day, which is a pretty significant swing. We talked about the 50% line being a key one for the percent of stocks above their 200-day. We are below that, around 38% going into today's close. I think we're going to go further down as some stocks broke below their 200-day moving average. So overall, the breadth picture has gone from bullish to neutral, and now I'm starting to see neutral to more bearish. Finally, just to finish off, I think the sentiment in the form of the AAII ratings continuing to be relatively negative. It's almost a 50% spread again between the bulls and the bears, favoring the bears, which means it's double the number of respondents saying bearish versus bullish. So the sentiment has certainly swung from sort of an even keel about 2 weeks ago to certainly leaning more on the bearish side. That's our market recap for today. And again, we hit on a lot of different things, but certainly seeing rotation. I'm seeing a lot of lines that I'm looking at to identify potential risk. I hope you're doing the same in your portfolios. Make sure you focus on the downside potential and where you want to reevaluate positions. Let's take a quick commercial break. Back with the final bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the final bar. This is your host, Dave Keller, here at StockCharts.com. As a reminder, we love hearing from you, hearing feedback on the show, hearing ideas for guests we could bring on the show, and answering all of your questions about the markets, investing, the charts, whatever it is. 2 ways to get a hold of us. Number one, shoot us an email, thefinalbar@StockCharts.com. We've gotten so many great questions from you. In a moment, we'll open the mailbag, and these are all questions from all of you in the last 24 hours or so. Also on Twitter, just tag us in something @FinalBarSCTV. We'll gather all those questions, answer as many as we can on the air. So let's get right to it. Here's the Final Bar mailbag for Friday afternoon. Question number one, do you place much stock in these ever-changing daily lists of top performers, winners, losers, gainers, laggards, etc.? Are these lists good for generating ideas for the next trading day or the next trading week? It's a really good question. So on our system, on StockCharts.com, on your dashboard, you have the ability to add these widgets that show, stocks moving up, stocks moving down, heavier volume, whatever. I tend to set these up looking at the scooter reports, and these are stocks that are having biggest gains and losses in their scooter rankings, which is their technical rating. It's a percentile rating based on their technical characteristics, essentially a measure of trends. The higher the number, the stronger the trend. You can also do what we would call market movers. You pick a universe, and then this is the most active stocks today. You can do percent up, percent down. So the question that you particularly asked was, how good are these lists for generating ideas? So here's what I'll tell you. Are they good for populating idea, right? Do you see Gap as the biggest gainer in the scooter rankings today? Does that mean you want to buy it? I hope not. I hope that is not the entirety of your process. What I found with lists like this tells you what you should be looking at. As an equity investor, with all the different names that you could buy or sell on any given day, you literally have thousands, if not tens of thousands of stocks that you could buy or sell at any given moment. So the challenge for an equity investor is not necessarily analyzing the chart correctly. It's looking at the right chart. It's identifying which charts you should be looking at. And that's where I think these lists can be really, really helpful. Knowing which stocks are moving, knowing which stocks are fluctuating, I think helps you focus on what names to look at. So a couple suggestions I would have for you. Number one, see what names appear on some of these lists, but then take a look at the charts. Have this be a way that you analyze the chart. So look at the chart of gap and see where is it at relative to key support and resistance levels? What are the long-term trends? What's the relative performance characteristics? All of those sorts of questions you should be asking as a technically oriented investor. Same with the scooter rankings. I think there's no difference there. The other thing I would say that you can also do, and we've talked about this before, is look at the scooter rankings, look at the market movers, and look at them and think about what sectors are represented there. It might be a little hard to do it on the dashboard. So if you click on charts and tools, go to scooter reports, and you can actually sort them, and you'll have some columns that show you the sector and the industry group that each of those stocks are in. So it might be interesting to see, for example, if you see all semiconductors up at the top of the list, that will tell you something. Or home builders all of a sudden are all appreciating very quickly. It gives you an opportunity to identify stocks that are moving and then evaluate them relative to key, sort of best practices of technical analysis, and see what you can come up with. So again, I think those lists are meaningful if they are the beginning of a well-designed technical process. Question number 2 was actually relatively wordy, but you sent a chart, so I'd love to show it here. This is the chart, and I hope you don't mind me showing the chart that you sent, but I thought it was well done here. Let's see. No one's talking about the broadening pattern on the NASDAQ composite. It also exists other places. Here it's looking at an Elliott wave count, a clear 5-wave pattern here for the last couple years. What are my thoughts on this if this is 5th wave in a broadening pattern? Okay, so what you're looking at here is the last 5 years or so, maybe a little more on the Qs. You're basically saying this is a big wave 4 at the 2015 bottom, and then this was a wave 1, wave 2, wave 3, wave 4, wave 5, and this is the end of a wave 5 of 5 here at the top of a broadening pattern. So listen, I appreciate what you're thinking. A couple issues I would have with this. So number one, again, I'm not an Elliott wave. I don't use Elliott wave day to day. I did, take the CMT exams. I studied them deeply, and I've worked with a lot of Elliottians, and I've watched their research and talked with them often because I find that there's value there. So a couple of mistakes, actually, if you look at your methodology here, and again, I'll limit this just to the amount we have. Couple of things. Number one, wave 3 is more often than not, if not always, the longest wave. That, wave 1 are the initial buyers. Wave 2 is the first pullback. Wave 3 is when all the money sort of buys into the trend. You have a long-term trend, then you have a shorter wave 4, and wave 5 is usually the last one. So if you're numbering wave 1 as this huge wave, that's a clear sign that you might be misnumbering things. I would revisit your wave count a little bit. Mistake number 2 is actually wave 1 and wave 4 can't overlap. That's one of the basic premises of Elliott wave. And so, again, I don't mean to speak negatively of analysis. I think this is a decent effort. The way I learned Elliott wave was locking myself in a room with a couple other guys taking the CMT exams. We would bring the charts up together and try to apply wave counts on a random chart and then critique each other. And I learned a ton from that. So those are 2 mistakes in your wave counts that I would revisit. Wave 3 is usually the longest wave. Wave 1 rarely is. Number 2, you can't have wave 1 and wave 4 overlap. Your question on the broadening pattern, I don't disagree with that. For me, though, broadening patterns, it's hard for me to want to be selling just based on that, because what this shows you is that the market continues to go to new highs, and for me, I'd probably want to continue owning that. I'd much rather look for a reversal of sorts, which I haven't seen yet. Question number 3, it's so obvious to me that the S&P and many stocks have an island reversal. Why don't we focus more on that? Why don't you put more of a focus on it? The implications now are for an Elliott wave count to test the bottom and break for the 5th wave. Okay, I hear what you're saying. You're actually talking about this. I would want to say this is on the daily S&P chart. Why are we not talking enough about the island reversal? Yeah, I think I mentioned that, and we've talked about how, that we sold off and then retested that gap area from there. For me, island reversals, I don't put a ton of weight on that on its own. I'm more concerned by its implications. You talk about a wave count. Again, I don't talk about wave counts, but I certainly talk about higher highs, lower lows, and the patterns of the market, and just looking for clearly defined uptrends and downtrends. So while the island reversal certainly appears to be very valid, and I think that's totally fair, and I think the fact that we found resistance right in that gap sort of validates what your point is. I'm less concerned with a wave count at this point, but I am concerned about a lower high and a potential lower low, and that's why I've keyed into that sort of 3,000 to 2,950 level. We're right at that sweet spot, which I think for a lot of Elliotticians as well sorts of validates that we now have a new downtrend that you need to start counting effectively. It's a great question. Finally, several stocks have made all-time highs. Some are near or off their all-time highs. How do you treat these things? With caution or with a vote of confidence? How do you know if you should ride out the momentum, add to an open position, versus letting money management take over and scale out of a position? That's a great philosophical question. How quickly can I answer something like this? Hopefully very quickly, because we're out of time for the mailbag segment. Here's what I would say, right? A stock like Microsoft is exactly what I think you're talking about. You know, stocks making new highs. So here's what I do. I often screen for stocks making new highs and stocks making new lows. I usually screen for 13-week highs and 13-week lows, because what I found is a lot of times that'll catch things earlier on in their trends. Early in my career, when I worked with a lot of hedge funds and guys that were traders, guys that were doing trading mean reversion, swing trading, and looking at short-term stuff, I was very big into buying low and selling high, and I focus a lot of my time on selling at a peak and buying at a low, and trying to identify when that was happening in real time, because that's what people were trying to do. When I spent time at a long-term money manager, vanilla equity only investing for the most part, I learned the wisdom of buying the new highs list as opposed to buying the new lows list. I was looking for weakness, and I found there's also something to be said for buying momentum, which means you buy strength. You buy stocks that are strong because you can assume that they're going stronger. That's when I really rotated my focus a lot more to trend following and understanding the value of trend. So stocks making new highs, all that tells you is that there are buyers willing to push this stock higher than it had been previously. That's a good thing. That's ideally what we want if we own the stock. So what do you do with that? So I think at that point, hopefully you are in trend following mode and you're using some sort of trailing stop to identify when you should be out. And that's why with the mindful 6 stocks that I showed you earlier, I'm looking at levels that if you would own them, those are levels, those breaking those swing lows, breaking support over the point that I would probably revisit them. And as a trend goes higher, you bump your stop up as well. And whether it's a trailing stop in the form of a percent, whether it's just using the previous swing lows, whether it's using a moving average, I think there are a lot of ways to lock in profits as a stock continues to gain. The other whole side, which we don't have enough time to go into, are looking at objectives. You gain 25% out of a base, you take some off just because it's gained that much, and you want to lock in some of those profits. So money management is something we can dig in a lot further. Hopefully that gives you a couple things to think about going into the weekend. We need to wrap the show though, folks, and go right to the 3 and 3 charts in 3 minutes. It's going to be about 1 minute, but here we go. Chart number 1 is looking at cap tiers. I mentioned with the mindful 6, I mentioned with some of these stocks like Microsoft, are they able to hold above their swing lows? I'm concerned right now on a closing basis that the mid cap index and the small cap index are now testing, if not just breaking, their swing lows from the second week in June. The S&P so far has remained above. The microcap index overall has remained above. But just like we've seen the advanced decline lines breaking down, I'm looking at some of those indexes on a closing basis, seeing if they can hold them or not. If they start to break those, I'd be concerned about further weakness. Chart number 2 is looking at breadth in the form of stocks above their 200-day moving average. And again, we remain below 50%. If and when we can get back above there, I will start being a little more constructive on stocks. At this point, though, I have to see this as an indication of breadth getting weaker, to say nothing of the fact that 30% of S&P members in the last 2 to 3 weeks have gone from above their 50-day to back below their 50-day. So we're seeing the indexes hold up okay, but a lot of stocks breaking down, which is usually a sign of a short-term top. And then finally, the relative strength of financials versus technology. I saw a lot of people get really excited about financials right about here when we saw the relative strength break to a new swing high. It is now broken down to yet another new 52-week low, suggesting this continued rotation away from financials into technology. Looking at the two of those, I don't see how you could justify owning a bank over a technology stock until that line meaningfully improves. Folks, that is our show, and that is a week for the Final Bar. Thanks so much for joining us every weekday after the close for the Final Bar. Shoot us an email anytime, thefinalbar at StockCharts.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.